how low will the stock market crash? Well, in this video, you guys are going to find out. I'm going to dive into the S&P 500 index and how low will this index fall. But this is not going to be one of those fear-mongering videos which you see online. This is going to be a real deep dive economic analysis. I'm going to look at earnings, we're going to look at inflation, we're going to look at all the factors which drive market prices to give you guys an overview of what's going on in the market right now and what will be coming up in 2022. So if that sounds like something you're curious about, feel free to stick around and watch this video. And with that being said, let's dive in. Okay, so what is the S&P 500? Well, the S&P 500 index, often referred to as the stock market or the market, is the 500 largest and best performing companies listed on US exchanges. So this index is weighted by market cap, and that means larger companies by market price actually take up more of the index. So for example, the FANG stocks, Facebook, Apple, Amazon, Netflix, and Google make up around 25% of the S&P 500, and now also included in that is Tesla. Now, generally what an investor like you would do is you'd purchase an index fund or a tracker or an exchange traded fund, as it's often called, to track the major index as closely as possible. So an example of this would be the Vanguard S&P 500 ETF with the ticker symbol VOO, and this has a very low expense ratio of just 0.03%, and this actual fund is outperformed the majority of active fund managers, and this is why the S&P 500 is one of the best places to invest and recommended by great investors, even stock pickers such as Warren Buffett right here. Okay, so what determines the price of the S&P 500? Well, it's determined by a few factors. The first main driver is the earnings of the underlying company. So these are the earnings of each individual company which go in to the index. So if the companies produce great earnings, then the index will do well overall. Makes sense. However, the second major driver is psychology, as sentiment, and also macroeconomic forces such as inflation, which do affect price to earnings multiples. So that is something which we need to take into account. Okay, so how often does the stock market correct? Well, here's a brief history lesson. So according to a recent study by a global asset management firm, since the end of World War II, there have been 84 pullbacks of 5% or more, 29 corrections, so this is where the stock market corrects by 10% or more, 9 bear markets of 20% or more, and 3 bear markets, real deep market crashes of 40% or more. But it's clear, despite all these catastrophes, from the dot-com bubble of the year 2000 to the financial crisis of 2008 and even the pandemic crash of 2020, the S&P 500 has crashed and risen again and again and again, and historically over time it has produced around 9 to 10% returns for investors such as yourself. Okay, so what's happening with the S&P 500 right now? Well, we can see in January 2020, it was around 3,225. Then there was a big crash, which was the last bear market, 30% crash in 2020. And then since then, it has actually over doubled in price and value. However, since December 2021, it has started to slide down, now down around 17%. If you guys are finding value in this video so far, and you do like these investing tips and analysis, feel free to subscribe to the channel by hitting that subscribe button and turning that notification bell on. And if you do find value in this video at any point, feel free to give it a big thumbs up. It helps out tremendously with the YouTube algorithm. Okay, so let's dive into the earnings of the S&P 500. So currently, we can see, according to data from FactSet, the percentage of S&P 500 companies beating earnings per share estimates is greater than the 5-year average. So that's fantastic news. That means the companies inside the S&P 500 are actually beating these earnings expectations. So that's a great fundamental indicator. Now, there was a slight caveat to that, and that was the index is reporting single-digit earnings growth for the first time since the last quarter of 2020. So that may be a bit of a red flag moving forward, and that we won't be seeing the type of growth we have been seeing historically. But as you can see from this chart here, if we look at the middle column, 79% of companies inside the S&P 500 beat analyst expectations for earnings. Now that's fantastic, and that's for Q1 of 2022. So you're probably saying to yourself now, Ben, if earnings are rising in these companies, why aren't we seeing the index go to the moon? Well, there's another reason for this, and the big elephant in the room is inflation, which is like a thundercloud hanging over the stock market right now. So if we dive into inflation here, the annual inflation rate in the US came in at 8.3% for April 2022. Now, this is higher than the Fed's 2% target, but the good news is it's down slightly from the 41-year high of 8.5% seen in March. So as you can see, there has been a slight tick downwards. Now, this could be the start of a new trend where inflation starts to trend lower, or it could just be a little blip in the high inflation we're seeing. It's too early to say at this point. Now, the issue with inflation is it increases the input costs for business. So this could be labor, materials, etc. The Federal Reserve, the central bank of the US, wants to curb this inflation, and they do this by raising interest rates, which they've recently done by 0.5%. And economists actually forecast the Fed to raise interest rates 7 times in 2022, reaching 2.9% in early 2023. So I know what you're thinking, Ben, why do we care about inflation interest rates? Well, this is the issue. If you're investing into the stock market, higher interest rates actually compress the price to earnings multiple for all stocks. We've already seen this with growth stocks, and it started in January 2021, where growth stocks started to decline huge, and we saw Cathie Wood having a disaster. And there was talk of ARK Invest actually sinking. So it's pretty crazy out there, and it's all to do with inflation and interest rates. Okay, so how will this play out? Well, I've got 4 possible scenarios for you. The first scenario is we see high earnings growth and high inflation. This is what we're currently seeing. Earnings are humming along nicely, but we're also seeing high inflation. In that scenario, we tend to get quite slow growth. It's okay, and probably the stock market will stay where it is at that point. The second scenario is we see lower earnings growth and lower inflation. Now, this wouldn't be great, really. The lower inflation's good, but the lower earnings growth is not good. So I'd probably expect at least another 10% correction on the market index in this scenario. Now, the third scenario, and the one which has got most investors scared right now, is what's called stagflation. And this is characterized by lower earnings growth and high inflation. So earnings start to decline, but inflation stays sky high. Now, this was last seen in the 1970s. As you can see here, gas shortage, which we're seeing right now. There were protests about the high price of food, which we're also seeing right now with food prices going up for many, many people. Oil prices are also at sky high, the same as they were back in the 1970s. Now, it was quite funny. I did an interview on this channel with a Wall Street investor who actually predicted this way back before it actually occurred.
I've been a big promoter of oil stocks. The stocks have underperformed the price of oil.
And everybody thought he was crazy because he was saying he was invested into oil. However, there is a big distinction between what was happening in the 1970s and what is happening right now. And that is the global energy supply has changed massively. The US is now the largest producer of oil thanks to fracking. We have a range of alternative energy sources, and we also get deflationary effects from all the technology and even remote working. Also, we don't have high unemployment. Unemployment's actually back to where it was pre-pandemic, and we also have nice earnings growth. So currently, we're not seeing a stagflation scenario, despite what you see in mainstream media where they try to scare everyone every single day. So Ben, could this actually happen? Well, it could happen given what's happening in Russia and all the crazy events in the world. There is a possibility of stagflation, but so far we're not seeing numbers which say that. Now, the final scenario is really positive, and I call this the Goldilocks scenario, and that is we get higher than expected earnings growth and low inflation, which is what analysts want and what Wall Street wants and what investors want. And that will mean the stock market will start to boom again and things will start to actually rebound, and that will be great news for everybody and all investors.
The show goes on!
Now, I know you guys tuned into this video because you wanted to know how low will the market fall. So I've actually done a bit of technical analysis as well to complement the fundamental analysis, so you can actually see some specific points, especially if you're invested into the market index. So as you can see here, I've put what's called a Fibonacci retracement and also a MACD. The S&P 500 is trading below that right now, which actually means it's probably oversold. It bounced off the 3,800 support. If it breaks through that, it'll drop by another 5% to 3,578. If it breaks through that, then we could be seeing quite a big crash, a 14% decline from where we are today, which would mean we would be in a bear market. But we aren't there yet. There's a couple of support lines to break through. So these could be some useful numbers to write down and watch, especially if you're invested into the market index. Okay, so that's today's video, guys. I hope you found this valuable. In summary, there's a lot of craziness going on in the world. The main two factors to watch will be inflation and also earnings. Ideally, as investors, we want inflation start to fall and earnings of companies to continue to grow. And as Peter Lynch, the great investor, once said, Coca-Cola's earnings went up 30 times over a period, and the stock price went up 30 times. It is as simple as that in the stock market. And as the great investor Warren Buffett once said, never bet against America. With that being said, if you guys did find value in this video, feel free to give it a big thumbs up. Helps out tremendously with the channel. If you haven't joined the investing family yet, feel free by hitting that subscribe button, turning that notification bell on. With that being said, thank you guys so much for watching. I hope you all have an incredible day, and I'll see you guys in my next video. Invest safe.